watchers. I need you to stop watching the missiles. And I definitely need you to stop panic selling your portfolio because some retired general on cable television just pointed at a map of the Strait of Hormuz and said the words, "unprecedented escalation," for the 14th time today. Yes, the strait is closed. We will get to that. Yes, the Dow just hit its lowest level of 2026. We will get to that too. But if you spend this entire video staring at the war in the stock market, you will miss the real story. And the real story is not in Tehran. It is not on Wall Street. It is underneath the streets of New York City in a vault that just lost 31% of its silver in 5 months. And not a single mainstream outlet has said a word about it. While $4 trillion evaporated from the stock market this week, while oil ripped above $85, while every headline on earth screamed war, 40 million ounces of physical silver quietly walked out the door of the COMEX vault. And that is not a data point. That is an evacuation. Ladies and gentlemen, Asian guy here. It is March 6th, 2026. The Dow just posted 47,685, the lowest print of the year. Oil is at $85 Brent. We need to talk about the 94% number. We need to talk about what Iran just did to the most important choke point on the planet, and we need to talk about why the banks cannot survive it. Let me walk you through what just happened because the speed of this is hard to comprehend. On February 28th, the United States and Israel launched Operation Epic Fury, a joint military strike against Iran. The Ayatollah was killed. Iran retaliated. 6 American service members are dead. In the Strait of Hormuz, the 21-mile wide corridor through which 20% of the world's oil passes every single day, is effectively shut down. Before the war, 138 ships transited the Strait of Hormuz every day. On March 3rd, the Joint Maritime Information Center recorded three ships. That is a 94% collapse in traffic through the most important shipping lane on Earth. The IRGC commander went on Iranian state television and declared the strait closed. He threatened to set ablaze any vessel that attempts to pass, and he was not bluffing. 5 tankers have been struck. One was set on fire off the coast of Oman. A container ship, the Saifin Prestige Conwario, was hit so badly the crew abandoned it. Over 150 vessels are stranded inside the Persian Gulf with nowhere to go. But here is the part that changes everything. Iran did not close Hormuz with a navy. They did not need battleships. They did not need mines. They used cheap drones, $50,000 each. And after the drones hit, the insurance companies did Iran's work for them. P&I clubs pulled war risk coverage effective March 5th. Without insurance, no shipping company on Earth will send a $200 million vessel through a war zone. Iran closed the Strait of Hormuz with drones and a phone call from Lloyd's of London. This is not a traffic jam. This is a heart attack. The aorta of the global oil system just got clamped shut. The damage is already cascading. Brent crude hit 85. WTI topped $80, the highest since January 2025. Oil surged 8% in a single session. Gas prices in the United States jumped 22 cents in 1 week to $3.19 a gallon. Natural gas in Europe doubled in 3 days, from 30 euros per megawatt hour to 60. VLCC freight rates, the cost to charter the biggest oil tankers on the planet, hit an all-time record of 423,136 per day, up 94% in 24 hours. And then the Houthis resumed attacks in the Red Sea. Suez traffic is being rerouted around the Cape of Good Hope, both choke points compromised at the same time. The head of commodity strategy at RBC Capital Markets called it the biggest energy crisis since the 1973 oil embargo. And the IEA warned on March 5th that a prolonged disruption could flip the entire global oil market into deficit. Now, the mainstream media is reporting this as a war story. That is not what this is. This is not a war story. This is an inflation story. This is an energy story. And by the time I am done, you will understand that this is a silver story. Because what Iran just did to the Strait of Hormuz is about to do to the Federal Reserve exactly what the delivery notices are doing to the COMEX vault. But here is the catch. The war did not break the system. The war just revealed how broken the system already was, because while Iran was closing the strait, the smart money was draining the one vault that matters. We need to talk about 88 million ounces. For those who are new here, let me explain what we are looking at, because unless you trade futures, you might not understand why this number should terrify every bank on Wall Street. The COMEX is the commodities exchange. It is where silver and gold futures contracts trade in the United States. When a bank or a hedge fund buys a silver futures contract, they are buying a promise, a piece of paper that says someone will deliver 5,000 ounces of silver on a specific date. The vault is where the actual metal sits that backs those promises. Registered silver is the metal with a warrant attached. It is real. It is deliverable. It is the only thing standing between the paper market and a default. Everything else is a line on a spreadsheet. As of this week, registered silver in the COMEX vault has fallen below 88 million ounces. In October 2025, it was 128 million ounces. That is 40 million ounces gone, a 31% decline in 5 months. On February 11th alone, 3.26 million ounces disappeared in a single day. That was the day the vault dropped below 100 million for the first time. And not a single mainstream financial outlet wrote a headline about it. Not one. But here is the number that should make your blood run cold. The open interest on COMEX, the total paper contracts outstanding, represents 230 million ounces of silver. There are 230 million ounces of paper promises sitting on top of 88 million ounces of real metal. Do the math. That is a leverage ratio of 2.6 to 1. If just 40% of contract holders stand for delivery, the vault is not stressed. It is not tight. It is empty. The COMEX stress index is sitting at 78 out of 100. The all-time high is 88. We are in the red zone. At the current pace of withdrawals, the vault hits 0 in 99 trading days, roughly 5 months. But that assumes the pace stays constant. And as of this week, the pace is accelerating. Because a war just closed the most important oil choke point on Earth, and the dollar is about to come under pressure that the Federal Reserve cannot contain, the market already knows something is wrong. Spot silver is trading above futures. This is called backwardation. In a healthy market, futures trade at a premium because you are paying for the convenience of future delivery. When spot trades above futures, the market is screaming one thing: I do not trust the future. I want the metal in my hand. Now, silver in Shanghai is trading at $104 an ounce. Silver in New York is at $94. That is a $10 gap. $10 per ounce. That is not a rounding error. That is not a time zone lag. That is the market telling you in plain English that the New York price is a fiction. During the January blow-off, that gap hit $20. In some Indian markets, physical silver was trading at the equivalent of $170 an ounce, while COMEX was printing $78. Two prices, two realities, and the gap is growing. And here's the signal that the mainstream will not show you. Bullion Vault, one of the largest retail precious metals platforms in the world, just reported that first-time buyer activity is running 559% above the 10-year daily average. The number of silver owners on the platform is up 40% year over year. This is not speculation. This is not a Reddit trade. This is a generational rotation into hard assets by people who looked at a closed straight and empty vault and a $4 trillion stock market wipeout and made a decision. CNBC is writing headlines about the Dow. Not a single headline mentions the 88 million ounces. Not one mentions the 99-day countdown. Not one mentions the 559% surge in new buyers. They are showing you the puppet show. The vault is being emptied behind the curtain, but it gets darker. Because now we have to answer the question that the Federal Reserve is terrified to confront. What happens when 85 oil meets an empty vault and a central bank that can only print paper? We need to talk about the doom loop. Last week, traders were pricing in multiple rate cuts for 2026. The soft landing was supposed to be real. Inflation was cooling, the economy was stable. That narrative just died in the Strait of Hormuz. As of today, the market is pricing in one rate cut this year. 1. There's a 97.3% probability that the Fed holds rates at 3.5 to 3.75% in March. Mortgage rates are back above 6%. The Dow hit 47,685, the lowest print of the year, and the Fed is staring at a screen showing two numbers it cannot reconcile. Number 1, oil at $85 and rising, which means inflation is coming back whether they like it or not. Number 2, the Dow at its lowest level of 2026 with $4 trillion in losses, which means the economy is breaking. The Fed now faces the same binary choice it has faced in every crisis since 1987. Choice A, keep rates high. Fight the inflation that $85 oil is about to unleash. This crashes the stock market further, triggers a recession, and exposes every leveraged position on every bank balance sheet in America. Choice B, cut rates, print money, bail out the system, save the banks but destroy the dollar, which sends gold and silver into orbit and accelerates the vault drain. They always choose choice B. They chose it in 2008. They chose it when the repo market froze in 2019. They chose it when COVID hit in 2020, and they printed $4 trillion in 3 months. They chose it after Liberation Day in April 2025 when tariffs crashed the Dow. And they will choose it again because no Federal Reserve chairman in history has had the courage to let the fire burn itself out. But here is the doom loop that makes this time different from every crisis before it. Follow the chain. The war closes, Hormuz, oil spikes, inflation returns. The Fed cannot cut rates to save the economy without pouring gasoline on the inflation fire. But if they do not cut, the stock market crashes further and the banks start bleeding from their leveraged positions. So eventually they print. The dollar weakens. Silver becomes cheaper for every foreign buyer on the planet. China, India, the Middle East, they accelerate purchases. The vault drain speeds up, 99 days becomes 60, then 30. The physical shortage worsens. The paper-physical gap widens, and the Fed is forced to print even more to contain the damage. It is a self-defeating feedback loop. They are trying to put out an oil fire by printing paper. Paper burns, and JP Morgan knows it. Their own research department just published a $6,300 gold target for end of 2026. That is 24% above today's price. Their own strategists are telling high net worth clients to buy precious metals while their trading desk participates in the paper market. The left hand is telling you to buy. The right hand is helping suppress the price. This is not incompetence. This is a confession. JP Morgan is not confused. JP Morgan is positioning. Do you think China is watching this and panicking? Beijing has been stockpiling gold and silver for years. They are paying $104 an ounce in Shanghai, a 10 premium over New York, and they are happy to do it. China buys 90% of Iran's oil exports. They have LNG reserves. They have been preparing for exactly this scenario. The $10 Shanghai premium is not desperation. It is strategy. They are converting dollars into metal while the dollar is being diluted to fight a war that is making everything worse. This is financial warfare. And the Fed just walked into a two-front conflict, one in the Strait and one in the vault. And it is losing both. So the Strait is closed. The vault is draining. The Fed is trapped. And the banks just watched $4 trillion disappear. Do not let the fire distract you from the exits, because the exits are closing. We need to talk about what happens when 99 days become 0. 99 trading days. That is how long the COMEX vault has at the current withdrawal pace before registered silver hits 0, 5 months. But the current pace was set before a war closed the Strait of Hormuz, before oil hit $85 before the dollar came under siege. Every data point we just walked through, the war, the oil shock, the insurance shutdown, the Shanghai premium, the 559% surge in new buyers. Every single one accelerates the drain. 99 days is the optimistic number. If oil stays above $85, inflation returns. If inflation returns, the dollar weakens. If the dollar weakens, silver becomes cheaper for every buyer outside America. If they buy more, the vault drains faster. If the vault drains faster, 99 days becomes 60, then 30. The war is not a sideshow. The war is a time machine for the vault collapse. And when the vault gets low enough, when the math becomes undeniable, the COMEX has a nuclear option. It is called force majeure. They declare that extraordinary circumstances have made physical delivery impossible. They cash settle every outstanding contract at the paper price. They pay you $82 for silver that costs $104 in Shanghai and $170 in Mumbai during a squeeze. They hand you a check for a building that no longer exists. The CME will issue a press release. It will be very polite, very professional. It will say something like, due to extraordinary market conditions, including geopolitical disruptions to global commodity flows, the exchange has elected to settle outstanding silver contracts via cash at the prevailing settlement price. Translation: we ran out of metal, the war gave us the perfect cover story, and you get paid in the currency that is causing the shortage. We are already seeing the early stages of the split. The Shanghai COMEX spread is $10 today. It was $20 during the January blow-off. In some Indian markets, physical silver traded at $170 equivalent, while COMEX printed $78. Two prices, two realities. And if delivery fails, if force majeure gets declared, that split becomes permanent. Paper silver at $80, physical silver at $150. Two markets. And if you are holding paper, futures, ETFs, unallocated accounts, you are holding a claim on a vault that lost 31% of its inventory in 5 months and has 99 days left on the clock. The CME has tried margin hikes to cool the market. They triggered temporary corrections. But a margin hike does not create silver. You cannot print it. You cannot download it. You cannot sanction it into existence. The annual supply deficit is 150 to 200 million ounces, and production has been stagnant for a decade. The COMEX stress index is at 78 out of 100. The all-time high is 88. The system is not bending. It is approaching the breaking point. This brings us to the verdict. Here's the verdict. We have walked through a war zone, a vault, and a central bank. We have seen the 94% collapse of shipping through the most important waterway on Earth. We have seen 40 million ounces of silver vanish from the COMEX in 5 months. We have seen $4 trillion erased from the stock market. And we have seen a Federal Reserve cornered between an inflation wave it cannot stop, and a financial system it cannot let fail. These three crises are not separate. They are one crisis with three faces. The war closes the oil breaks the economy forces the Fed to print. The printing destroys the dollar, and the dollar's destruction reveals the vault. The vault is empty. For years, they told you silver was a pet rock. For years, they told you the banks were too smart to fail and the system was too strong to break. This week, the Strait of Hormuz went silent. The Dow lost 4 trillion, and the COMEX vault crossed below 88 million ounces with 99 days left on the clock. And you, the person who bought silver at $30, who held through the $120 spike, who held through the $78 crash, who is sitting here right now watching this video while the rest of the world panics about headlines, you are holding the one asset that cannot be printed, cannot be hacked, cannot be sanctioned, and cannot be closed by a drone strike on a tanker. Do not sell your silver because the Dow crashed. The Dow crash is the reason your silver is about to become the most important asset you own. The $4 trillion that left the stock market has to go somewhere. The smart money, the 559% surge in new buyers, the central banks, the sovereign wealth funds, the family offices, they already know where it is going. They're not watching CNBC. They're watching the vault. Watch the vault. Not the price. The price is noise. The vault is the signal. When registered silver drops below 80 million, the countdown accelerates. When it drops below 50 million, the game changes permanently. The price will catch up to the vault. It always does. The strait is closed. The vault is draining. The banks have no exit. They cannot fight inflation. They cannot save the banks. They cannot print silver. The war ends. The printing starts. The metal wins. Do not trade your insurance policy for the currency that is causing the fire. Hold the line. I am John A.G. The war is the distraction. The vault is the proof. And 88 million ounces is the number that changes everything. Remember to like, subscribe, and share this video. See you on the other side.